investment in Florida has become so attractive for Canadians.
When you invest in U.S. real estate, you're ultimately going to be subject to U.S. tax.
LLC is a corporation-like entity, but it is not a corporation.
When it's an LLC and you have Canadian investors, you got to be careful.
Having a Canadian corporation being a member of a U.S. partnership.
You know, the rule is if you're not recognizing income, you can't recognize a foreign tax credit.
All right, U.S. tax. Okay, so Brian, I always tell people when it comes to U.S. tax, I only know enough to cause damage. Every single Canadian CPA only knows enough about U.S. tax to cause damage. So today I want to talk about a couple of different things. For sure, we're going to talk about U.S. taxation for Canadian real estate investors. That is for sure. We'll cover that in detail. And if time permits, I do want to talk about Canadian small businesses specifically expanding into the United States, what sort of issues that they're going to run into, and best practices. All right. So why don't you give me a bit of a background on yourself, your area of practice, and just pronounce your firm for me.
Perfect. I rehearsed in front of the mirror this morning,
good.
so that's great. Okay, so brief background about me. Grew up here in the GTA area, went to New York for school, practiced at the Big Four for a few years, but I was actually in assurance. Came back to Toronto, eventually transitioned into cross-border taxation, which was kind of a natural move. I was licensed in the US, sort of had the academic U.S. tax background, but you know, it was a good foundation, but definitely learned a lot more along the way. Practiced at another mid-sized firm, also in the Greater Toronto area. About a year and a half ago, switched over to Greywell Guyot, that's their name. We're up in Richmond Hill, a very fast-growing practice, and you know, I think you guys can relate to this. The cross-border space is just taking off. Clients just, you know, they want to move into the U.S. Whatever business they're in, we're going to talk about real estate, but it's really across all industries. So Greywell Guyot just had an influx of cross-border files that were coming in, and they wanted to start servicing it in-house. So I came on board to essentially start the U.S. cross-border tax division. So we handle everything across the board. Whenever there's something to do with Canada, something to do with the U.S., in the same scenario, we handle that. So individuals, businesses, trusts and estates across all industries.
I think I can speak for the both of us. So Mark and I, we both run independently our own small practices, and we're seeing this kind of stuff all the time. People expanding across the border both ways, actually. You know, I have a lot of Americans wanting to expand into Canada, and then Canadians expanding into America from a business perspective, but definitely from a real estate perspective, and definitely in the state of Florida. Right? Because, you know, if you look outside the window right now, you can see the beautiful Canadian weather that we have here in November. You can't exactly go out tanning right now.
Even with the hurricanes, people still want to be there rather than here.
They still want to be there, right?
That says something.
And I know that Mark and I both wanted to bring you on because we wanted a bunch of free advice, and this is a great way to get to sit you down for an hour and not get charged for it. Right.
We signed some engagement letters in the back there before the cameras rolled.
Exactly. But the reality is Florida is a very popular place for Canadians. I don't have the statistics in front of me, but there's about 500,000, I don't know if it's units or Canadians owning property in the state of Florida. That's just the state of Florida, let alone the rest of the United States, right? So it's a very popular destination, not just for what we would call them snowbirds, but also now, I know you guys are finding this too, like a lot of interest in investors moving into the state of Florida. So prior to this interview, I flew down to Florida and I interviewed a number of professionals down there, and the investment environment in Florida seems to be more geared towards the landlord than the tenant, let's say, than here in Canada, in the sense that there's a lot more leeway, a lot more freedom for the landlords to operate their business the way that they want. And I think that's one of the reasons that investment in Florida has become so attractive for Canadians, because a lot of Canadian investors here are sort of sick of the bureaucracy and the loopholes that they have to jump through with their tenants here.
Especially when managing from afar, you want the landlord's favored, because if you have to deal with issues,
Exactly. But also, Mark, I'm sure you guys are seeing people expanding into the U.S. from a business perspective.
Yeah, and I think even just to diversify the real estate portfolio, right? And now obviously the U.S. is an attractive sort of different arm that they can start building out their real estate practice. So, you know, one of the things when clients come to me and kind of want to expand into the U.S., it's kind of like, you know, my taxation accounting is restricted to Canada, like yours, Fabio. So it's kind of like, what do you advise them? Like, what's kind of the first thing you tell them 101, you know, when expanding into the U.S. invest in real estate?
Right. Oh, it's sort of hard to say because clients come from different perspectives. Some are snowbirds, like you mentioned. Some want to buy a property to live in year round and not rent it out. Snowbirds might want to rent it out during the summer months when they're back here in Toronto or wherever they live. There's sort of more robust real estate investors taking public money, getting a deal together, and that's sort of on a grander scale. So we kind of have to sort of nail what we're talking about.
Yeah.
The objectives.
Let's start with the simplest thing. I want people to understand the basics of the US tax system. It's very similar to our system of taxation here in the sense that it's a voluntary reporting system, in the sense that, you voluntarily report your taxes on a tax return. You're basically tasked with being correct, right? Like the onus is on the taxpayer to be correct.
For the most part, yeah.
Right? Correct. So it's going to have many, many, many similarities with our taxation system. But I think that once you dig deep into it, it's very different from our taxation system. So what are the first and foremost, the primary concerns of somebody wanting to expand into property ownership in the United States, regardless of whether they are going to build property, sell property, or rent property out, or just simply use it as a vacation home? What are the first concerns that you have as a cross-border specialist when somebody says they want to do that?
Well, one thing that it's important to realize, and this is obvious for many, but not obvious for many as well, when you invest in U.S. real estate, you're ultimately going to be subject to U.S. tax. And that's not necessarily so intuitive because we invest in U.S. exchange traded funds, mutual funds, stocks of Apple and IBM and whatnot, and we never see U.S. tax from that. When we invest in U.S. stock and we get a dividend, there's actually withholding tax, but it's all taken care of on the back end. And when we sell those shares, we're not subject to U.S. tax. That's just the way the cross-border tax rules work for things other than real estate. But when we deal with U.S. real estate, that is physical, tangible property in the U.S. At that point, the U.S. tax clause sort of come out closer to you. And when you have rental income, you have to start reporting that on an annual basis. And certainly when you dispose of a property, that has to be reported and you have to pay tax in the U.S. So it's a whole nother tax system that you have to get on board with. You might need U.S. tax ID numbers, certainly need a U.S. tax accountant to advise you and file those returns for you. There's a withholding tax regime. So much like in Canada, if you're a non-resident of the U.S. and you have U.S. income, very often withholding tax applies. So when you go to sell a property, you might have 15% of that proceeds of that sale withheld off the top.
That's
FIRPTA. Exactly.
Okay.
FIRPTA.
On the gross amount, correct?
On the gross amount, exactly. So it can be a wild overestimate of the ultimate tax liability, especially if you have a high cost basis or the property has gone down in value or you have a lot of closing costs or whatever it is. So especially if you're an investor and you're doing these deals on an ongoing basis, that can slow down your cash flow. You might ultimately get withholdings back, but depending on where in the year you sell, you might be waiting 15, 16 months for that recovery of those withholdings. So when you're trying to set up a structure, you have to consider, that withholding tax. How soon are you going to sell that property? Am I okay waiting several months to recover that cash? Or do I want to make sure my structure takes that into account and avoids withholding tax? So withholding tax is just one particular issue, but there's a variety of structures and each one sort of favors different items and you can't really satisfy everything. You sort of have to pick and choose which features you want in your structures and which features you're willing to give up on.
Right. So let's take the simplest situation. This usually happens not necessarily with my younger clients, but usually my older, like financial planning clients. They'll be like, Fab, sick of being here in the winter and I just want to smash out 3 to 6 months a year in Florida, January, maybe come back in April, May. I want to buy a property. I found a nice place for $500,000, whatever it is, something like that they can afford. Initially, when they buy that property, there's really no tax issues. And if they don't rent the property out, once again, there's no tax issues.
Yeah.
But the first thing that pops up in my mind is, okay, well, is there a residency issue from a tax perspective? And when you want to sell that property, is there a tax issue, which you've already covered? Yes, there is a tax issue. And what if that property goes up in value, up and up and up and up and up, and they hold it for 30 years and they die? Is there an estate tax issue? So let's start with the initial problem that I'm seeing is there some sort of a residency issue? Like, can you be in the United States for a certain amount of time? And then now we have the CRA and the IRS saying, hey, fighting over who's
your tax residency?
Yeah, where's your tax residency? Because I don't think that people are thinking about that.
Yeah, Yeah, good question. And I like the way you phrase that because you really sort of run through the timeline of owning a property there and all the issues that could arise. So in terms of residency, the way it works sort of by default is if you spend more than half the year in the US, you're considered a US resident. I mean, it's not exactly half the year. There's sort of a calculation based on the number of days you were there in the current year plus the number of days in the prior years. There's a bit of a formula there. But in general, it's about half the year. And those are the default rules. But the Canada-US tax treaty says even if you're in the US for even 365 days of the year, if you maintain closer ties to Canada, you're not deemed a US resident. So you get out of US residency. And Florida is actually a great state to be in because the US-Canada tax treaty applies at the federal level only. Some states do respect it, some don't. Florida does not levy income tax on individuals. So regardless, there's no Florida tax consequences. And as long as you maintain closer ties to Canada, you're not deemed to be a US tax resident. So you can stay there, certainly during the winter months. If you stay there, most of the year, it might still be fine depending on how close your ties are back to Canada. So that depends on, where's your family, where's your friends, where are your cultural and religious ties, where's your property? I mean, you'll have one property in Florida, but you might have another residence back in Canada.
That's available to you. You have your gym membership, you have your credit cards, you have your banking here. Okay.
Exactly.
So it's based on residential ties. That's the sort of tiebreaker thing that you're looking at in the treaty.
Yeah,
Okay,
exactly.
So that's good news.
Yeah.
Good news.
And it should go without saying, if you're going to take that position, you're still considered a Canadian resident for tax purposes. Like you have to be a resident of at least one country at the end of the day.
Okay. That answers that question. That's great. Super clear. Now, that brings me to the next point. When we sell the property, now I went over this in a lot of detail in a previous podcast with a U.S. attorney. Everything was super clear, but I just want to make sure that people understand when you sell a property in the United States, there is an immediate obligation to withhold tax, correct? In the US.
Yeah, an obligation on the purchaser of the property if you are a non-resident of the US. So real estate agents, real estate lawyers, I mean, this should be on their radar, especially in a state like Florida, where you have a lot of people who are not residents of the US owning Florida property and selling Florida property. Sometimes it slips under the radar, maybe in another state where they're not expecting someone who's not an American to sell a property. But yeah, part of the due diligence in the closing process will be determining, is the seller a US person or not? And if they're not a US person, then the withholding regime is going to apply.
Okay. And what was the amount again? 15?
It varies. It's typically 15%, I believe. And I think it applies when the proceeds are in excess of 300 grand.
Yeah,
So if you
there
sell
is.
for
Yeah,
less than
yes.
that. So if you sell for less than that, then the withholding doesn't apply. And even when it does apply by default, there are ways to mitigate that. Oftentimes it's not worth it. What you do is you essentially apply for what's called a withholding exemption certificate from the IRS. So upon closing, you'll get, let's say, 85% of the proceeds, assuming no mortgage and whatever. You'll get 85%. 15% the buyer will withhold. It'll go into escrow. At that time, you'll apply to the IRS and say, hey, listen, I'm a non-resident of the US. I'm selling this property, but my ultimate tax on this property is going to be zero because the property depreciated in value. So therefore, this withholding tax doesn't make sense to me. It shouldn't apply it. And the IRS looks at your application, looks at your documentation, says, okay, fine, we'll exempt you from the withholding tax. You take that letter back to the closing agent and they say, okay, here's the 15%.
And they release some money. And if you don't do this in time, because this has happened to a couple of my clients, your money will be stuck sometimes upwards of years. For years. So on $1 million property, you could have 150 grand stuck
sitting there
for a while.
Yeah. I mean, in theory, as long as you file your tax return, which won't be due until the next year, you can get a refund of that. And it could come, within a few months, ideally.
Right.
We don't see backups for years typically. We have clients now that are selling properties. They're asking me, is it worth it to apply for this withholding exemption? And I say, no, we're in November or December and you'll have the withholdings and we can file your US tax return as early as January or February and you'll get that money back maybe in March or April or May. Going through this process to exempt the withholdings could take 3, 4, 5, 6, 7 months. And that's more unpredictable than the standard tax return process. So at the end of the day, you got to weigh the costs and benefits.
Right.
So building on that now, let's say, as a Canadian practitioner, you have a wealthy client who has excess cash and now they want want to start investing in the US, or
Yeah.
they want to buy even just a vacation home in the US.
Yeah.
What's the best approach on kind of advising them how to do that? Like, do they just buy it personally? Do they set up a holding company, buy it through there? Because I know, and correct me if I'm wrong, by holding US real estate personally, there could be estate issues, which kind of leads us into the last part of our conversation.
Yeah, exactly. And estate issues are pretty important to consider. As of right now, there is an estate exemption available to US citizens of 13.6 million. So if you're an American, you die with net worth of less than 13.6 million, there's no estate tax.
And no deemed disposition like we have here in Canada.
None of that. Yeah, in Canada we have a
Talk
deemed
about building generational wealth, huh? Like,
right. The 13.6 million, that can go a long way. That amount is set to, well, it increased for 2025, probably in the 14 million range with inflation. It's set to cut in half in a couple of years from now, down to something like 7 or 8 million. So if you die with less than that amount in net worth, then you're not subject to any estate tax. In Canada, like you said, we have deemed disposition rules. So the so-called death tax works a little bit different in either country. So when you're a non-resident alien, you're subject to U.S. estate tax only on U.S. situs, U.S. situated property, real estate. And it actually applies to U.S. stock as well. So if you hold shares of Apple or IBM, even in a Questrade account, you're
like
actually
a Canadian
subject.
brokerage account.
Yeah.
Okay.
You're actually subject to U.S. estate tax. So if you pass away and you hold more than $60,000 worth of U.S. stock, you actually have to file an estate tax return. The Canadian financial institutions are pretty relaxed about this. Like they'll just release the money to your estate. They generally won't ask you if
I've never seen them ask anything.
Yeah, exactly. But if we're ever filing a U.S. estate tax return for a non-resident alien of the U.S. who passed away holding U.S. real estate, I'll ask the question, did you hold U.S. stock? I'll lump it in there just to make sure they're compliant.
Yeah.
So bottom line is, if you pass away with less than 13.6 million in global net worth as a non-resident alien, you will not be subject to U.S. estate tax on your U.S. property. Because what happens is, even though you're not a U.S. citizen, you get a prorated credit as if you were a U.S. citizen. And that proration is based on the ratio of your U.S. assets to your total assets upon death. So the way the math shakes out, as long as your gross worldwide estate is under that 13.6 million, you will not owe any estate tax. The only drawback is upon death, your estate will have to take care of filing a one-time U.S. estate tax return. And
in order to get the exemption.
Exactly. Well, in order to, you have to file to report. Like you said, it's sort of a voluntary reporting system, but you have to file to report that that the deceased owned a U.S. asset upon death. And yes, on that tax return, you claim that exemption.
Will they ask for, sorry to interrupt, but will they ask for letters of probate? Like, how do you prove your estate is below? Because $13 million sounds like a lot to people, but it's actually not. Like easily, I 25 random clients just popped into my head when I did the math, and I'm like, they're all over 13 million USD.
Right.
Just with a property, a business, their house, their cottage, and their $1.5 million US condo that they have.
Yeah.
Easily it could be 15 to $20 million, and they're not even ultra rich, right? So they're going to owe some tax. How do you prove to the IRS that your estate is underneath that threshold?
Yeah, well, you have to provide an accounting to the IRS with this tax return of your worldwide gross estate. So you're telling them about your Canadian property, shares in Canadian companies, your vehicles located in Canada even, because that goes into that ratio of calculating that exemption credit.
And it's gross estate, so gross of any debts against real estate, or
I'm not.
That's a tough. That's tough. Yeah, that's a tough one, right?
Yeah, it's funny because most of our clients in this situation, they don't have any debt because they're older.
Yeah.
I don't recall if you reduce the estate for any mortgages on the property. I don't think you reduce it for any other personal debt.
We can just check that later, but I think the main thing is, if you've got an estate that you think is worth over $10 million, let's say you're kind of getting close to that magic number, you better look into it, because otherwise they could freeze your assets in the States, no? Can't they?
Yeah, well, we've run into this situation with clients. I'll give you an example scenario. Husband and wife owned a property jointly, a Florida property. They live here in Canada. One spouse passed away, and now the surviving spouse wants to sell the property. So upon closing, they realize that half the title of the property used to be in someone else's name who's now deceased. So they ask, did you file an estate tax return? Did you get clearance from the IRS on this asset? So you're trying to close on the property, and now you have this other obligation that you have to rush to fulfill so that the buyer doesn't walk away.
So what are the, I guess, the penalty, because it's building on the voluntary reporting in Canada and the US, what are some of the penalties and risks of not knowing about this and not properly filing the estate return?
Yeah. So besides for blowing up your closing, when the surviving estate or beneficiaries sells the property, it can theoretically give you a lower cost basis of the property when you ultimately sell. So what happens is when you pass away and you own U.S. property, the cost basis to your survivors who inherit the property is the value upon death, which is a good thing, especially if you're exempt from estate tax. So you basically had all this tax-free appreciation and value, at least from a U.S. perspective. But if you don't file this estate tax return, the IRS can theoretically attribute the original basis of the property to your survivors who ultimately sell it. So, I've seen properties purchased in the late 60s that have literally quadrupled in value. And you don't want to have that original basis.
So they'll give you from a U.S. tax. Let me just make sure I understand this. They will give you, when you die, your beneficiaries a bump up from a U.S. tax. So you can theoretically, at least from a U.S., because you don't get the deferral at the Canadian level, but from a U.S. tax perspective, you can perpetually get a bump up in ACB and never pay capital gains.
Yeah, as long as you organize that people die on you. I'm just kidding. But yeah, that's exactly.
We're Italian. We can make that happen.
Okay. I'm just going to look the other way on that one. But yeah, exactly. So in that respect, it's a pretty sweet deal. But I think the key point here is if you're a Canadian and your worldwide estate is expected to hit that threshold, whatever it is, like I said, it could be only 7 or 8 million within a few years. You want to think about setting up a structure that mitigates this estate tax.
Okay.
And the flip side of that is if your gross estate is more modest, you don't necessarily need to put yourself in fancy, costly structures from day one. Okay. And I think that's something that people don't realize. They're incurring tons of legal fees, tons of ongoing accounting fees year after year just to prepare corporate tax returns, financial statements, extra bookkeeping, whatever it is. And at the end of the day, they're mitigating one estate tax filing upon death.
And it makes no sense.
It makes no sense.
Do the damn tax return at death.
You're not going through that hassle. It's your children or your beneficiaries. Mm-hmm. So the way I like to approach these things with my clients is let's actually look at not just the after-tax costs, but the after-tax plus legal and accounting fees costs of operating these things. And it has to really make sense.
Okay. So I definitely want to come back to the estate issue, but Marc brought up about structuring. So let's move on to, all right, we understand the snowbirds want to buy a vacation property. If you're approaching that level of net worth where you think you're going to exceed whatever the threshold may be, now 13 million, it's going to go down to 7 million. Whatever that threshold is, we got to do some estate planning in terms of the way that we structure the purchase.
Yeah.
We understand that when you sell, there's going to be a withholding tax, and we have to plan around that withholding tax. Otherwise, your cash flow is going to get screwed up. Okay. Mm-hmm. Now, let's say I'm going in as a pure capitalist and I'm like, hey, listen, I want to get in on this rental market in the US. Specifically, let's deal with Florida, just because that's really where all the interest has been with, I think, your clientele, my clientele. Mm-hmm. Sure. That's where it's all been at the moment. So I want to move into Florida and I want to buy a property, and it's really just throwing $1 million into this property. It's me, my spouse, or me, my brother-in-law, maybe 1 or 2 people. Simple, buying a property. We're going to rent it out, long-term rental. We're never going to personally use it. That's it. The biggest question that I get, and I don't know the answer, and I've been explained the answer a million times, but it always RAM, it goes in one year out the other, right? I'm like, there's too much shit that I need to know about the Canadian situation that I don't even want to. It comes in my head, and I say, Brian, just talk to Brian.
Fair enough,
right? But what are our options? Now, I know that in the States, their business structures are a little bit different than ours. Yeah. And I see these things called LLCs, C Corps, S Corps, and then a familiar one would be an LP or a limited partnership, which we have here in Canada. Can we walk through these different structures and kind of just the basics? So I know none of us are lawyers, but we do know what these things are. What are the basics here? People here are used to corporation. We say corporation. Mm-hmm. That's it. End of story. And that takes care of 99% of all our problems here in Ontario, right? That's not the case there, because the first thing when I interviewed the attorney down there, he started yapping about LLCs.
I bet, yeah.
That was the first thing. He went on for 20 minutes before I interrupted him and said, hey, we got a tax problem with LLC here in Canada.
Yeah.
So why don't we go through that? Let's go through LLC, C and S Corp, and LP. Let's just cover what the heck those things are.
Yeah. So the first comment I'd make is there are legal structures in Canada and there are legal structures in the US, and sometimes they're not congruent with each other. So let's start with the LLC, for instance. The LLC, it stands for Limited Liability Company, is a very popular tax structure in the US. Hence, the attorney you spoke with immediately jumped to it. And the reason for that is it kind of mixes legal benefits with tax benefits. The LLC is kind of like a corporation. So if you buy a property and you put the title to the property in the name of an LLC, now the owner of the LLC has limited liability. So it's like a corporation, which is great. From a tax perspective, the default classification of an LLC when there's only one owner is as a flow-through entity, kind of like a partnership, but it's not a partnership. So let's say an individual opens up an LLC, then purchases US property, all the rental income and the gains from that property jump right through the LLC to the individual. So there could be tax benefits to that if you can capture those rental losses throughout the life of the property, for instance. But from a Canadian perspective, the LLC is actually treated as if it's a separate entity, as if it's a corporation. So you have a different tax treatment on either side of the border. And why that is important is you want to constantly be thinking about foreign tax credits and mitigating double taxation. When there's two differing tax treatments, something's going to go wrong. In this case, the LLC, for Canadian purposes, is not taxed on its accrued income retained in the LLC because it's treated as a corporation. I mean, you might have FAPI and things like that, but by default, anything in a corporation is sheltered from tax to the owner of the corporation in Canada. So you're actually only taxed when you distribute earnings out of the LLC, kind of like a dividend. It's treated like a dividend for Canadian tax purposes. For US tax purposes, you can move cash from an LLC bank account to a personal bank account all day long, back and forth, whatever. It's not a taxable event because the LLC is treated as if it doesn't exist for tax purposes.
I think the term you guys use is a disregarded entity.
Exactly.
Right?
Exactly.
Okay.
It's a disregarded entity. You pretend it's not there. It's there for legal purposes, which is why it's so great. Protects you from a liability standpoint. So for US purposes, you're taxed when you actually earn rental income because it accrues right to you as the owner of the LLC. And again, on the Canadian side, you're only taxed on distributions out of the LLC. You could be earning income on one side of the border this year, but earning that same income on the other side of the border when you distribute it in a future year. And that really messes up the foreign tax credits, leads to double taxation. You know, worst case scenario, leaving state tax aside, that's state, not e-state. Leaving state tax aside, you could be taxed up to 60, 70% if you have an LLC structure and you're not careful about it. So with LLCs, there's a way to implement them from a cross-border perspective in a way that it doesn't lead you to double taxation. So if you really want to set one up, make sure it's done in the correct way. And in general, that way is have the LLC owned by a U.S. corporation.
Okay.
Because that acts as a blocker for Canadian tax purposes.
So that's perfect. That segues into a U.S. corporation. So essentially,
Yeah.
like just for my purposes or for anybody wanting to get into the United States, obviously you should consult with somebody who understands the cross-border issues rather than just going straight to a U.S. advisor because
sure.
they're going to throw you into the LLC
100%.
structure because that's what works down there.
100%.
But that is going to likely lead to a double taxation issue here in Canada if structured incorrectly, leading to somewhere, I guess, 60 to 70% tax.
Yeah.
Right? Okay, so we definitely don't want that. So let's go to a US corporation because an LLC is a corporation-like entity, but it is not a corporation, correct?
For U.S. purposes.
For
it's
U.S.
not,
purposes.
right.
For Canadian purposes, we consider it a corp.
Exactly.
But for U.S. purposes, it's not. This brings us to, I guess, C Corps and S Corps, whatever the hell that means.
Yeah.
Right.
Yeah. Let's knock off S Corps because that's not really going to be relevant here. S Corps can only be owned by U.S. citizens and U.S. residents for the most part.
So we'll ignore that.
Yeah. And not only that, it's not really so efficient when you're owning real estate. But we can certainly talk about C Corps.
Okay.
What's good about C Corps, just like what's good about Canadian Corps, is you can can shelter income inside of them, right? So you could buy a property through a C Corp, earn rental income, and pay only 21% tax on that rental income. Now, kind of like in Canada, nobody has rental income. They have cash flow, but they don't have rental income because of depreciation. So just like there's CCA in Canada, there's US tax depreciation in the US. So thinking about the taxation of rental income throughout the life of the property, it's really not so relevant because you're going to have losses.
And they force you to take the depreciation,
Yes.
right? It's not because here in Canada, depreciation from at least a tax perspective, obviously not an accounting perspective, but from a tax perspective is an election.
Right.
I take it if I want to.
Right.
And to be quite frank, 90% of my clients don't take they just pay the taxes because they don't want to have to deal with it, the recapture later on.
When they
in
sell
the US, that's not an option.
Right.
It must be taken over, what is it, 20 years? I can't even remember.
27 and a half years or 39 years, depending on if it's residential property or
Those are weird numbers.
or non-residential. Yeah.
Whatever they came up with those.
Fucking Americans.
Yeah, it's freaking Congress, right? So you're going to generally have rental losses throughout the life of the property. Now, when those rental losses are accrued to a corporation, those losses can only offset income that's also in the corporation.
So it's locked.
It's locked,
Like here,
yeah.
like here.
Like here.
Okay.
Yeah. So you got to realize that if you're going into a U.S. C Corp to purchase the real estate. Certainly other benefits of a U.S. C Corp. It could protect you from estate tax if the U.S. C Corp is owned by a Canadian holding corp, other potential benefits. Also that limited liability feature as well, just like the LLC does. So there's certainly other benefits to a C Corp, but you sort of have to recognize that the losses are trapped. Secondly, you're subject to FAPI, which is a Canadian tax regime for an accrual property income, which is essentially anti-deferral rules. The CRA or the Income Tax Act doesn't like it when Canadians set up non-Canadian entities and earn rental income in them, because now that rental income is removed from the Canada tax net. It's in the US tax net. In short, FAPI is basically saying, let's impute the income from the corporation and let's tax it to the shareholder of the US corporation.
Which would be the Canadian here.
Yeah.
So just a tax here in Canada, even though you haven't paid anything in the US.
Yeah.
Or haven't had any obligation to pay because you have no taxable income there.
Right, potentially. I mean, for FAPI purposes, you sort of do a recalculation of rental income on a Canadian tax basis. So you could elect to take CCA and then your FAPI income could be reduced.
Yeah, that's a big headache.
So there's a little more compliance that goes with it year over year, but that's something you have to sort of deal with when you're invested through a US C Corp.
So do you find you have clients come to you who've just received the wrong advice, they've been set up in a way and they have no idea of these rules, such as like FAPI, and they come to you and they're in a disaster of a situation?
Sometimes, because what happens is they're sitting here in Canada and they're thinking, oh, let's go buy a property in Florida. Okay, so then maybe they take a flight, they go down there, they see a property they like, and then they go across the street, they knock on a CPA's door, they knock on a lawyer's door. So they're talking to someone based in Florida. So to really get the right advice, you have to talk to someone who's specializes in cross-border tax, specifically US, Canada. And there's not a lot of them out there. I'm certainly one of them, but they are out there. They're in the Greater Toronto area. There are some in Florida, because again, there's a lot of Canadians going down there. Right. There are some in Florida that are really good. And I've certainly worked with lawyers down there who understand the Canadian tax as well. But you just have to know who you're talking to. Make sure it's someone who understands both sides of the border. Because if you get US advice from a professional who's looking at US in a vacuum and not considering the fact that you're a Canadian resident, you might get trapped into an LLC or into a poor structure or into a state tax exposure. So to make sure all these boxes are checked, talk to someone who knows cross-border. That's the bottom line. I'm obviously biased, but hey, that's what I do.
Definitely. I always say there's three pieces of legislation, broad legislation. There's the code in the States for American tax, federal at least, right? There's the Income Tax Act here in Canada, and then there's the treaty. So there's three bodies of legislation. Then there's two administrative bodies, the CRA and the IRS. Then there's state issues. So to just talk to somebody who only understands one side of the border, then come back and talk to the guy who understands your side of the border, you need a translator.
Yeah.
Right?
Yeah.
So you need somebody that understands both sides of the border along with the mitigating legislation, the treaty, and how to put it all together. It's a completely different ballgame.
Yeah. Yeah. Right? And especially, I see this with young people. They're very enthusiastic, very excited about buying their first rental property, and they found one, they're getting a great deal, but they're moving too fast. They have to slow down. Sometimes they're not even thinking about like tax. Like they're buying a property and then they're like, oh, I'm gonna cash flow it. It's gonna be great, or I'm gonna go there and live in it on the beach. It's
gonna be awesome.
For 3 months of the year. It's gonna
Yeah.
be awesome. But there's a certain maturity you have to take it slow and talk to the right people.
Sorry. So a quick question. So in Canada, like, we see it all the time. People come to you with crappy structures.
Yeah.
They want to sell their business, whatnot. And then it's tough to get them out of that structure.
Sometimes.
Right. In the US, when someone comes to you with a crappy structure, how difficult is it to sort of reorganize to get them in a proper structure? Because in Canada, you have accrued gains, you have to worry about land transfer tax, a whole bunch of stuff. So
Yeah.
how does it work down in the States?
It's essentially the same difficulties. I mean, there's tax rollover provisions in Canada that make getting out of these kinds of messes a little bit easier. There's similar provisions there. It's not exactly congruent, but it's messy. And even if it can be done on a tax-free basis, you're incurring extra legal costs and tax costs to do the planning for it.
As opposed to just paying that up front to get it properly structured, which
Exactly.
a lot of people don't see. And I think a lot of times people try to avoid the fees of using like a specialist like yourself, which I
Yeah.
think is the wrong thing to do, because at the end of the day, it's you upfront pay the fees to
Yeah.
avoid these disasters down the road.
Yeah, exactly. Like I actually spoke to a client just yesterday. He's not in real estate, but they run some kind of rubber pavement business. I don't remember exactly, but they're expanding from Canada to the US. They went on www.createanllc.com. It was literally something like that. And they set up an LLC. And then they came to me after the fact. And I'm like, whoa, let's slow down here. But I asked them, what have you done so far in the US? And all they did was take customer deposits. They haven't earned any revenue yet. So when they're early in the game, it's easier for these people to untangle that mess. I essentially advise them to just create a US C Corp and have that own the LLC.
Right.
So very simple fix there. But when you have a big fat asset like a property and you've already struck the match, it might be more difficult to untangle.
Yeah, once the problem metastasizes, you're fucked. Okay, so we covered the LLC structure. We covered the basics of a C Corp. It's basically a corp. It's similar to what like
Exactly.
a corporation that we're used to here. Canadian investors, Canadian business owners, and lawyers and accountants are used to here. Now, at least not in Ontario. Out in I guess it would be the West Coast, they're more used to this, but I kind of like this structure, the LP or the limited partnership structure. And in essence, the way it works here in Canada is you create a partnership, and one of the partners, a very small minority partner, will be the general managing partner. Okay. And we just set it up as a numbered company, a corporation. Then all the limited partners who will have no management involvement in the business enterprise or in the rental property will simply make an investment. That investment will be made as a capital injection. So what does this allow us to do here in Canada? This allows us to limit all the liability to this blank corporation that has no assets necessarily and has made no real monetary contribution to the structure. So that's great. That's like a corporation. It gives us limited liability, but it allows us to flow income and losses and retain the tax characteristics of those incomes and losses from the partnership out to the various different partners.
Yeah.
And their at-risk amount is whatever they initially put into the business in terms of capital injection, and they can't be sued for anything more, theoretically. I'm not a lawyer, so
Yeah.
don't take my word for it. It's a great structure. It's a little bit difficult to understand. It's a little bit more difficult to account for. And advisors here in Ontario are not really primed to understand it for the most part. We don't use it a lot, but I think it's very useful. My understanding is it's pretty much the exact same thing in the US, right?
Yeah.
And it's used more in the US.
Yeah, very frequently. Sometimes it's an LLC instead of an LP. LP in the US stands for limited partnership, just like it does in Canada. So when it's an LLC and you have Canadian investors, you got to be careful.
Right.
Because now you have Canadian investors in an LLC. So typically when there's a Canadian deal, there's limited partnerships. If there are LLCs, they're sort of lower down in the structure. If you sort of picture an org chart, they're lower down in the structure, closer to the property level. And there's various blockers in place that distance the Canadians from that LLC. So if it's done right, it's not a problem. But yeah, the LP structure, the GPLP structure you're describing works exactly the same in the US, and it works fabulously for Canadians, bringing together a group of investors, perhaps with a general partner like you're describing, and can mitigate double taxation because all the losses from the LP can just flow right through to the individual investor, be it a Canadian hold corp or an individual.
Okay.
So let's say you're a Canadian business owner. You've accumulated this wealth in your operating company, and now you want to invest in the US using this sort of LP structure. So who would be the partner of that LP? Would it be a holding company, Canadian holdco, that you can transfer the funds into? Like, how would it work?
Yeah, you certainly, well, in theory, you could have the opco, the operating company, hold the interest in the LP because there should be limited liability in there. You might get into some passive investment rules on the Canadian side. If you earn too much passive investment income, it could drive down your small business deduction, obviously. But, generally most individuals who have amassed an operating company and sizable wealth, they just set up separate holding companies to hold these types of investments.
Split off the U.S. assets from the Canadian arm, right? Purify, keep that all separate. That's the best approach, even for your capital gains exemption and whatnot.
Yeah, exactly. In certain cases, there's not really an issue with mixing and matching U.S. and Canadian investments. But, we have clients, as I'm sure you do, who have massive portfolios, and it's just a lot easier to administer when things are separated by country,
Right.
or by asset type.
So I guess then, I suppose the typical example would be an entrepreneur here in Canada has an opco, maybe a holding company. They've amassed whatever, a couple $1 million, they want to get in on a property in the US, right? So obviously they don't want to pull the money out to themselves in order to make a personal investment because we're going to get hit with 50% tax, right? They don't want to, and maybe we can cover why they don't want to necessarily buy the property in the US with their Canadian holding company, right? They legally can, but
that's a no-no for sure.
But we can cover why that's a no-no. So then they're left with either an LLC, a C Corp, or an LP in the US.
Yeah.
And I think it's sounding like the LP might be the better strategy, right? Than the LLC is obviously a stupid strategy. We've already kind of determined that from the Canadian perspective because we're going to get double taxed, it looks like. The C Corp may be fine. There might be a little bit of bleed with withholding tax or whatnot.
Yeah.
But we might have trouble with foreign tax credit there. I don't know. And then the LP structure seems pretty attractive to me. Right?
Well, what's good about the LP structure is those losses flow right through to the investor. So you can actually invest individually in a U.S. limited partnership holding U.S. real estate, and those losses it spawns out can actually offset your wage income or your other investment income, which is a great thing. And there's rules in the U.S. that limit you to do that if you're a U.S. citizen. So in Canada, it's much more favorable when you're investing in U.S. real estate to use those losses against your Canadian income.
But I mean, let's say you don't have losses. Let's say you have, the situation becomes where you have rental income, like taxable rental income, here in Canada, and you don't want to take your depreciation. Yeah. I still think it's better with the LP because it just comes in as regular rental income. Yeah. I don't think there's we can get into the withholding tax actually. Right. There will be.
So on the LP, there will be,
Yeah, there will be
the C Corp,
tax.
no.
Okay. There will be a withholding tax, but you should be able to get the tax credit for that withholding tax in Canada.
So whenever there's withholding tax, that's not your final tax liability in general. I mean, with withholding tax on dividends from a U.S. company, yes, that is your final tax liability. But when we deal with withholding tax in the context of real estate, it's simply just like a payroll withholding. You file your U.S. tax return and you have your tax owing, and then you reduce it by the withholding tax. It's like a credit.
Okay.
So when you ultimately compute your foreign tax credits, you first have to complete the tax return and compute that final tax liability.
Okay. So let's say imagine you have a tax liability. You just have a great, not super leveraged property, and tax depreciation doesn't cover all of your, revenues. Yeah. And you have some profit in the U.S. You pay a little bit of U.S. tax on the rental income. In that scenario, if it's an LP, you should theoretically then here in Canada be able to get the foreign tax credit.
Yeah, right? Absolutely. So the partner in the limited partnership will file U.S. tax returns to report that positive rental income. So they'll pay federal and perhaps state tax as well. And all that tax paid will go to offset the Canadian tax owing, because as a Canadian resident, you report your worldwide income.
Right.
So you're reporting this rental income as well, but there should be no double taxation. And in general, Canadian tax rates are higher than U.S. tax rates, even when you consider some U.S. states. In Ontario, it climbs as high as 53.53%. You're never going to hit that in the U.S., even in the highest tax brackets, even in California or New York, which are high tax states. So your ultimate tax cost is going to be the higher of the two tax rates, which will usually be the Canadian tax rate that you're subject to.
But you should get a nice flow through. I guess the only issue I'm seeing, so then to like rewind it back to my simple, how we started the conversation, my simple situation, myself and my spouse, or myself and my brother-in-law, or myself and my friend want to buy $1 million rental property in the state of Florida. Probably, if we want to get the best of legal protection and tax and tax treatment, the LP sounds like the most attractive structure.
Yeah, it's
right?
a great,
Right. But even if we're doing this from our small business corporation or a group, our small business corporation group or holding company that has retained earnings, it's still sounding like possibly the LP structure in some form or another is the better option, right? I guess the only issue would be having a Canadian corporation being a member of a U.S. partnership, right? That could also lead to
withholding tax, for
withholding
instance.
taxes.
Yeah, so definitely different things to weigh. In the U.S. C Corp, you don't have any withholding tax, which is a plus, but those losses are trapped. In the LP, you do have withholding tax if you have Canadian partners in it, but the partners get to use those losses. So, you got to think about which tax attributes you want to favor. Another thing I'd say is LPs tend to be better when you have a large group of investors. Maybe lawyers can speak to this, but I think partnership agreements are cleaner to deal with than shareholder agreements. And if you want people jumping in and out of the deals, I think a partnership structure is better.
Okay.
Yeah.
So you made an interesting point, because I think 90% of small business owners in Canada probably have the holdco opco structure, just to purify, or just to creditor proof their holdco, flow up the dividends tax free. And you said it's a no to have the Canadian holdco invest in the U.S.
Directly in the property.
Yeah.
They
can take ownership of.
So you want to explain to that, just so the risks of that, the pitfalls?
Yeah, sure. So the owner of any property is going to be subject to all the liability on the property. So if someone, God forbid, slips and falls on that property, generally they're going to be suing the owner. So in a GP-LP structure, they're going to be suing the GP, and the GP is going to be in a typical U.S. deal. It's going to be a U.S. corporation that maybe has a bank account with $3,000 in it and has a little bit of operating expenses and nothing else. It's a shell for all intents and purposes. So they're going to go, you're going to sue the GP, you're going to get nothing. If you have a corporation owning a property, let's say it's a U.S. corporation, so you're going to sue the U.S. corporation and there's a property there. So the property is exposed, and I think the property is always going to be exposed. That's just
that's just part of the game. Yeah,
you can't mitigate that. But what you want to mitigate is exposure to other assets unrelated to the property. When you're a Canadian holdco directly owning U.S. real estate, someone who sues you is going to sue your Canadian holdco, and now all the other assets inside your Canadian holdco are up for grabs. Which is why with real estate, you really want to segregate the assets there. A lot of people, they have one separate corporation for every single property they have. I think people sometimes go a little too crazy over that. They buy these $250,000 properties in the Midwest, and they have a corporation or a limited partnership for each, and it's like
it's a lot.
They're paying 15, 20 grand in fees to operate a property worth only 5 times that. So it eats up their return on investment. So again, goes back to what I was saying before. You got to be practical, mitigate the liability, but maybe take a chance to lower your operating costs when you feel you can do so.
Okay. So then, let's do a case study, right? Like literally, I come to you and I'm a Canadian business owner. I've built up some retained earnings. I've got, a holding company with some stocks, some bonds, some this, some that, you know what I mean? And I say, listen, I'm looking at expanding into the state of Florida. I want to buy a property there. The sole purpose of this property, I'm going to start throwing things some curveballs actually.
Like a notepad or something,
Yeah, sure.
I want to buy, I've got $1 million sitting here. I've got access to another $1 million of financing in the US. Okay. And I want to buy this $2 million 10-plex outskirts of Fort Lauderdale. Okay. How am I doing this? And I don't want to pull money out of my Canadian corporation to myself to do it. It's just going to be me.
Right.
How do I structure this expansion?
Right. So I think really your two options are C Corp or limited partnership. That's really what we've been talking about. One thing to consider is what is the longevity of this particular investment? Do you plan to hold it for years or
Till I die and pass it to my kids?
Till you die. Okay. Yeah. So, in that case, I think maybe you'd want to favor a C Corp.
Because of the estate, estate, the big tax bill is going to be at the estate level.
Yeah,
right?
Exactly. So the U.S. you'd have a U.S. C Corp purchasing the real estate, and the Canadian Holdco owning the U.S. Corp.
Okay.
And in that scenario, when you pass away, your Canadian Holdco doesn't pass away. So the Canadian Holdco is really the one owning the U.S. assets because they're holding the shares in the U.S. company. So the Canadian Holdco is not subject to estate tax, right? So you've completely mitigated your estate tax with the U.S. C Corp. So if you're holding an asset for life, I think, if it's just you don't have any other investors, I'd probably favor that C Corp structure.
Okay, because there's going to be no estate tax issue.
Yeah, no estate tax issue, no withholding tax issue. I mean, there's just going to be a one-time sale upon death probably, but there's actually withholding tax on rental income as a non-resident. So if you earn that rental income in the C Corp, there's no withholding tax. So by going into that structure, you've mitigated withholding tax forever, which is positive. Okay. I think one of the drawbacks is you're probably generating rental losses every year. I mean, if you're only 50% leveraged, I've been keeping track of the facts so far. If you're only 50% leveraged, your interest expense might be a little bit modest. So you might have positive taxable rental income, but to the extent you have losses, they will be trapped in the corporation and unavailable to your Canadian Holdco. And unavailable to you as a Canadian individual as well. So,
I don't think there'll be huge losses with 50% equity in the property, good rent. Yeah, I think, okay, so a C Corp in this particular case. So now let's make a little bit of a change.
Yeah.
I might hold this property for 10 years, but my kids' rental properties that are more difficult to manage, which, and being an absentee owner, in the state of Florida, I'm here in Toronto or somewhere else in Canada, that's going to be a difficult one to manage, right? I'm probably going to liquidate that before I die, right?
Yeah.
Does your advice change? Am I still doing this through a C Corp or am I doing it in an alternative manner?
I feel like a C Corp is still better.
Still better?
Yeah.
Okay.
I think we start to favor limited partnerships once you bring on a group of investors, especially third-party investors. The LP structure just seems to be better for that in terms of managing the deal over time.
And because each individual partner may have a different situation, it kind of doesn't matter because you retain the tax characteristics when you flow it out to them.
Exactly. So each partner gets their own tax attributes. It's taxed at their personal rate.
Okay.
And it just seems to work better when there's more people and you can't control everybody.
Okay. Now, I do want to get into business expansion, but I do have another question about real estate. So we have a lot of people, and I talked about this in Florida a lot. We have a lot of people that they have this idea that they're going to buy some sort of a property in Florida or somewhere where they like to go to and utilize this property personally, but either short-term rental when they're not there, or even month, 2 month, 3 month rentals when they're not there. So it's kind of like a mixed use property.
Yeah.
And I know when you have a mixed use property here in Canada, especially if you're using corporate funds to fund this property, you're getting into some issues for sure. Definitely getting into some issues. Shareholder expropriation of corporate assets, let's say. You can get into a punitive taxation issue there. But are there any issues purely from a tax perspective? Because we already covered the legal and other issues in the US, but from a pure tax perspective, if I'm flying down to Florida, using a property, flying back, throwing it on Airbnb once in a while, what are the tax issues of a situation like that?
Right. Well, one of the tax issues arises to the extent you're using the property for personal use. So we have shareholder benefit rules here in Canada. Similar rules apply in the US. So once you're using a property for personal use and that property is held through a corporation, you have to pay rent to that corporation.
Like a market rate of rent.
Exactly.
Okay.
Exactly. So if you don't do that, in theory, the fair market value of that use of the property is a deemed dividend out to you, which you don't want. You don't want a dividend. There's withholding tax and all that. So to the extent you're using property personally, there's maybe better structures than a corporation.
Does it happen with an LP?
Not with an LP. No.
Okay.
Yeah.
So maybe then, okay.
Yeah. So an LP could work. There'd be no shareholder benefit issue there.
Right. Because the first thing that pops up in my mind is, an Airbnb short-term rental in Miami or Fort Lauderdale. There's just exposure to litigation, right?
Yeah.
I don't want to own that asset personally.
Yeah.
You know what I mean? So, but if a corporation's going to lead to a tax issue, then,
Yeah.
What's the best
maybe the
alternative?
LP.
Yeah. So sometimes you got to bite the bullet and go through a corporation anyways.
Yeah.
And pay market rent to the corporation. You could, I think you could pay it out of a Canadian holdco. So the Canadian holdco could get a deduction for the rent. I'd have to double check that, but bite the bullet and just pay the rent to the corporation.
Yeah.
And you get it's still your money. You get a little bit of a tax drag on that, maybe.
Right.
But you might have to bite the bullet and go through a corporation. That's the bottom line.
You have anything more for
real estate?
Real estate?
I wanted to pivot into the business, operating a business.
I think that you lead it.
Yeah. So essentially, one of the biggest things I see with my Canadian clients is, they want to expand into the US.
Yeah.
And, they have a Canadian operation here, their bottom line is solid, and there's an opportunity to obtain market share in the US. So from your perspective, the easiest thing would be from a Canadian, or without any legal or accounting advice, would just be, okay, just start selling in the US. Let's just, purchase, an office space there, buying product and start selling it.
Right.
What are the risks of doing that just without even consulting anyone or even looking into potential issues with that?
Yeah, sure. So assuming you already have a Canadian operating company that is holding your business. So if you start operating in the US and you're physically there, you have employees, you have an office, now you have what's known as a US branch. So you're operating as your Canadian company, but for all intents and purposes, you're treated just like a US corporation operating there. But the drawback, there's many drawbacks to that in comparison to operating through a US C Corp. Part of that is you can be subject to branch profits tax. So according to the Canada-US tax treaty, to the extent you have over $500,000 of earnings that you've deemed to sort of repatriate back to Canada, you're subject to a 5% branch profits tax. And that branch profits tax doesn't apply in a US Corp. There's the 5% withholding tax on dividends, which sort of mimics that 5% branch profits tax. But either way, you're mitigating the branch profits tax by operating out of a U.S. corp. And going back to operations out of a Canadian corp, sometimes you have less familiarity with your vendors. They don't like doing business with a Canadian entity. So that's a barrier a lot of my clients have come into. Some of them will have a certain level of revenue in the U.S., but then once they start selling to Walmart, or a big retailer, now suddenly the big retailer says, okay, we can bring your product in, but we want you to operate out of a U.S. entity.
Right. And also the limitation of liability, right? Like there's way more lawsuits flung around in the U.S. than here in Canada. I would suppose that, you're operating through your Canadian company directly there, everything's exposed.
Yeah.
Right. Whereas I'd rather limit the liability to the U.S. operations in the U.S.
Yeah, exactly.
Right?
To the extent you can sort of slice and dice your operations to segregate liability into sort of smaller units, as long as it makes sense from a business perspective, that you should do that. So at the very least, segregating your Canadian versus U.S. ops limits your liability.
Even for just tax planning perspectives on keeping your Canadian operating company pure, right, and separating your non-Canadian assets, right, out of your Canadian operating company, there's an advantage to that. Is there a certain threshold before, like, they'll kind of say, okay, now we're going to assess you with a branch tax because you're operating a like kind of its own establishment here in the U.S.? Like, what's sort of like the things they look at? Like in Canada, if you want to look at like different rules, if you're a contractor between an employee, there's different thresholds. Do they have something similar?
I think it's $500,000, right?
Is it an income threshold?
So $500,000 is for the branch profits tax, but I think what you're getting at is when do you start operating a US branch in the US? So is it when you put one foot over the border and you sell a candy bar, or what's that threshold? And it's a great question. And it's something we're constantly looking at with our clients to make sure they don't get too comfy in the US and start operating as a US company. So one thing I'd say is it's not really so dependent on your level of revenue, which is a common misconception. There are Canadian companies with millions of dollars in revenue in the US, and they are not deemed to be operating a US branch. What it really comes down to is this concept of permanent establishment, which is a term in the tax treaty. I think it's a term in the US tax code and the Canadian tax code as well. So if you're in the US and you have employees there and or you have a fixed office or place of business, at that point, you're probably deemed to have a permanent establishment, and then you have a US branch. Anything short of that, so let's say you want to sell product in the US, you hire, let's say, salespeople who are simply contractors for you working on commission, and they might get a prospective customer and they communicate this prospect back to the Canadian office for approval of that deal, of that sale. That is a protected activity. So you're not deemed to have a permanent establishment at that point. And under the Canada-US tax treaty, you can operate in the US without a permanent establishment and not be subject to branch tax as a Canadian company.
But you still may be subject to income tax, though, in general?
In Canada only.
Not in the US.
So no income tax in the US.
So really, you have to have a branch. You have to have a permanent establishment there
Exactly.
in order to actually be subject to either branch tax or income tax, whether that's state or federal.
Yeah, well, state is sort of a different beast.
Okay.
Kind of like what I said before, some states respect the Canada-US tax treaty, sometimes some don't. So you kind of have to be a little bit careful there. But certainly from a federal level, if you're in the US and you're doing some sort of business, but you don't have a permanent establishment, you're completely exempt from federal taxation. You should be filing what's called a protective treaty-based US tax return every year just to disclose
The
your
treaty
position.
exemption. Right.
Exactly.
Okay.
You basically just disclose your gross revenue.
And that's
to the
for
US.
anybody doing any form of sales or business cross-border. I always tell them as well, I say, you know what, just for a piece of insurance, just file that
Yeah.
treaty-based exemption every year.
Yeah.
Every year.
So one common misconception is that if you have US customers, you're automatically in the US tax net, which is not the case. You actually have to be physically in the US. You have to be there, or your business has to be there. There has to be some connection there. So sometimes that could mean shipping goods from Canada to the US. Then you're physically there. At least the good is there. So if
Providing accounting services from here to there, I'm not going
Exactly.
there. Okay.
Exactly. So we do that all the time. There's no US tax implications whatsoever. For service-based companies, it's quite straightforward from an income tax perspective. You have to physically be there in order to start being considered for income tax. And that applies at the state level as well. So it's not even a treaty thing.
I get it.
Now, sales tax is a bit of a different beast. Sales tax could apply.
Yeah, that like nexus there, like that's a whole
That's a whole
university course.
I'd say so.
Yeah.
And I don't know how deep you want to go into it, but
I don't even want to hear about that crap.
Okay. Done.
I'm good with just the income tax. So
Yeah.
so I mean, as soon as you start selling to the U.S., you have to look at whether or not you're physically there.
Yeah.
Right. If you're physically there, you may have a permanent establishment. Now we have to start filing a full-blown U.S. tax return. You're going to probably have some sort of obligation in the U.S. You may want to start thinking about opening a U.S. entity, and it's probably going to be a C Corp owned by a holding company here in Canada.
Exactly.
Right? So that we can get that nice flow through without getting hammered with too much excess tax, and you get to repatriate the profits here and limit liability over to the United States.
Yeah. So in terms of repatriation of profits, there's really two ways to do that. You can pay a dividend out of the U.S. corporation. That's going to attract a 5% withholding tax, which is not great, especially because that 5% isn't really recoverable as a foreign tax credit, because that dividend is typically considered exempt surplus to the Canadian corporation. So, the rule is if you're not recognizing income, you can't recognize a foreign tax credit, right? So really you want to strip out earnings via some kind of management fee. And at that point we get into transfer pricing issues. Because the theory is if you're paying out an excessive amount of management fees out of the US, you're taking a tax deduction in the US and you're limiting your US corporate taxable income and essentially gypping the US government corporate tax. So they want to make sure the management fees you're paying out are reasonable, are reflective of the service actually being provided by whoever you're paying the management fee to. Oftentimes it's simply the shareholder, but it could be another related party. Companies have complicated org charts a lot of times.
Yeah, I want to do what Apple is doing, paying zero fucking tax at all in the United States. Just everything gets sent over to the Caymans or Ireland or wherever, right? Like,
right. Well,
obviously they have access to like teams of these transfer pricing specialists, but I think what you're explaining here is really, there has to be some sort of actual economic reason for a charge from a Canadian company to, especially a related Canadian company to a US company. Am I correct?
Yeah, exactly. So when we do tax planning for these structures, a lot of our clients, the way they view it is, okay, I earned this much in profit, therefore that's the amount in management fees I'm going to pay back, which you don't want to say out loud. That's how we're all, at the end of the day, that's how they're all thinking, and it makes perfect sense. But from a transfer pricing point of view, you do not want your management fees to be correlated with your profits or revenue per se. Like you're saying, you want them to be reflective of the services being provided by the recipient of those management fees.
So I think this is a common misconception of sort of, even in Canada and in the US, I'm assuming that assessing the reasonability of management fees is similar from Canada to the US, probably, give or take. But I think one thing is that what are some things we can tell, the general public, because everyone does it, they want a management fee income from one company to another to shelter losses. And I'm sure it's the same in the US. What are some things that the US looks at to sort of assess the reasonability of the management fees to make sure you're sort of in line and not just management feeing out your profits?
Right. So there's a whole sort of subcategory of accountants / financial professionals that deal with transfer pricing. And if you hire them, what they can do is they can look at your operations, look at your org structure, the nature of your business, the industry, the services being provided, and they can come up with a reasonable management fee structure. Essentially, they'll provide you a formula to calculate those management fees. And, they give you a 100-page PDF and backup and documentation for how this was calculated. And, you just stick that on your hard drive in case you ever get audited for those management fees. And
so similar to Canada.
Yeah, similar to Canada.
And as long as it's reasonable to, like, what would you pay an arm's length third party
to
provide similar service, not just because you're the shareholder, right? I'm sure that's a big thing that they look at also.
Exactly. That's the idea. But it's not something businesses think about from day one when they open up operations there, just because they haven't had $1 of revenue and they don't want to pay thousands of dollars for what's known as a transfer pricing study. So there's sort of a critical point. I don't know what that dollar value is, but once they get big enough, I think the cost of having that transfer pricing backup is well worth mitigating the transfer pricing risk in terms of getting audited from management fees that you pay out. So, generally it's bigger companies that engage in these transfer pricing studies. I'm sure Apple has to have their transfer pricing study updated every day as things are moving, and they're under the microscope. Smaller businesses, mom and pop businesses coming from Canada to the US, they're not really on the radar. So in practice, a lot of them don't really consider transfer pricing for a long while.
I think it's looked over. I think it's something that like people don't consider. And I think it is a risk. Obviously, small mom and pop shops, they don't really have to think but there's a risk to it. There's an element of risk to it. Yeah. I think it's a common thing, not only in the US, but in Canada, that a lot of people don't consider. And I think that depending on the size of your, even big operations, they don't even consider it, right? But it's something that, as a general practitioner, you should be advising at some point down the line, right?
Yeah. And it's sometimes clients, they hear you, but they don't take it to heart, and at the end of the day, they just want to zero out the profits in the U.S. corporation, and that's just how it is. And most of the time, when they're not really a big fish, they don't get audited, and it's fine. But you're right. In theory, they should be considering transfer pricing.
Do we have time for another? I want to pivot to another sort of quickly. So now we talked about corporations, Canadian corporation opening up a US operation and running their business in the US. How about if you're an individual now working in Canada and you're required to go operate in the US? I know I've seen situations before where people are just traveling to the US and just working out of there and then coming back and whatnot. And then the US comes and they hit them with a big tax bill. And it's like, well, now because you've been kind of residing in this state for X amount of days, you owe this amount of taxes, and it's always a big ordeal.
Right.
So what are some sort of things that to look at when then you have an individual now who's working both in Canada and the US?
Right. So are they working for a company, and are they working for themselves? Are they?
We see it a lot with these sort of consultants, where they're independent consultants, let's call them, but they're really providing services to one company. In the US. That's how is that what you're seeing?
Yes.
I see this a lot.
Yeah.
So they're working remotely from Canada on the things that they need to work remotely for, but they're flying down to, I don't know, the state of California over and over and over to do seminars, trade shows, this, that, the other.
Yeah.
And they're always there. What do these people need to know?
So they have to consider the permanent establishment concept that we just spoke about a few minutes ago. So that applies to corporations, but it really applies to any business. So as an individual, we might not think about it, but we're operating businesses whenever we provide consulting services and the like. So it's going to come down to, do you have a permanent establishment in the US with respect to your business? So it could mean that you own a property there and you sleep there every night when you're there, but that's not really part of your business. Do you have an office that you're operating your business out of? As a business owner, do you have employees working for you that you're paying in the US? So those are the kinds of things that would trigger permanent establishment. So if you're sort of more on a consulting basis, typically those people do not fall into that permanent establishment bucket and can get out of paying federal tax at least, but they should file a non-resident US return every year to disclose their gross revenue and that treaty position as well. And again, it's a treaty position just like it is for a Canadian corporation as well. For states, you kind of have to go on a state-by-state basis, see if they respect the treaty. Some don't respect the treaty, but have other rules that favor you coming in on sort of a consulting basis, and they won't tax you. So state by state, you got to take it on a case-by-case basis, but federal, look at that permanent establishment concept.
So the answer is, for everything that we've discussed today, call you.
Yeah, exactly. I hope your appetite is wet. And
I'm just as fucking confused as I was at the beginning. So I'm just gonna call you. That's it.
Not sure if that means I did a good job or a bad job. I guess if you call me, I'm happy.
No, you're good.
That's it. No, I mean, listen, we covered what I wanted to cover. Obviously, we're not going to solve all the world's problems from a cross-border tax perspective. It's way too complicated. It's literally a sub-specialization of tax, which is a specialization of accounting and law. So I think that the big thing that I'm getting out of this is, if you're going to be going to the States just to close one small deal here and there, maybe you're just providing some services to Americans as part of your business, no problem. You want to buy a $250,000 small vacation rental property, or not rental property, a small vacation property that you're going to use yourself in the state. There's really no issues other than having that physical asset in the US. There's going to be a little bit of a withholding tax issue when you sell it, or possibly when you die, right? But if you are going to be getting people together to buy a larger property in the United States, or if your business, you're using some retained earnings in a corporation here in Canada to buy a rental property in the United States, or you're expanding you're really doing business in the US, this is when you're going to want to do some homework ahead of time, and probably, an ounce of prevention with a person like you is going to be worth, a ton of cure from dealing with, cross-border, somebody like you, or a cross-border tax attorney, right? So I think that's the overall lesson that I've gotten out of this. I think you've covered the main points that I wanted to cover. Marc, is there any additional
No,
info you want
absolutely.
to get because
No.
it's your chance.
No, absolutely.
After
Yeah, I
that,
think
he's going to charge you.
yeah.
All good.
Then he's on the clock.
Yeah.
No, I just think knowing your risks and just kind of knowing where your boundaries are as a practitioner here in Canada is critical, especially if you have clients who are cross border, and just understanding the risks and just consulting the proper professional advice.
I'd say, obviously talk to an advisor, a cross-border advisor. Don't chat GPT your situation and get advice out of that, even though it's inexpensive and fast. And have your advisor get to know you a little bit, know your situation, know your deal, know your objectives, your goals. Don't just send him an email, hey, I'm looking to buy a property, what's the best structure? And then expect an email back. Like, really take the time, go through it. There's a lot of attributes, a lot of risks, benefits. Certain structures favor estate tax, certain structures favor loss utilization. You got to weigh everything. You got to think about not just where you are, but where you're going to be in 5-10 years with your specific US asset. So definitely a lot of things that go into that decision-making process.
Awesome. Thanks for coming by.
Yeah,
My
thank
pleasure.
you.
Thank you for having me. This was a blast.